There we go. All right, so debt-free life. What debt-free life is, this is an infinite bank or a private bank. This is Symmetry's proprietary version of an infinite bank or a private bank, and it's actually a play on words. Debt, because most of the people that we talk to about these programs are in some kind of debt, and our goal is to eliminate people's debts quickly. The life is that we're specifically using life insurance as the vehicle or the vessel of the infinite bank. So when you go out there and you study the different versions of infinite banks that are out there, and there's a ton of them, you're going to hear some of them. I'm not going to give them lip service because they typically will fail. But there are programs out there that use IULs as infinite banks. There are programs out there that use HELOCs, home equity lines of credit, as infinite banks. There's programs out there that'll try to sell you a piece of software to help you execute what's called a sweeps campaign to move money from one account to another account to capture a higher interest rate and then move it back. All those programs have the capacity to succeed, but most of them will fail at some point. And so for me, having done all the research that I have and looked at all these different versions and different mechanisms that they use, for me, it's a no-brainer for me to use what we use, the debt-free life program, because it's based on participating whole life. And we'll talk about that a little bit more as we get deeper into this. So the first thing that we're looking at is there's two primary questions that we try to ask. And the first question is, are you 100% sure you're going to have a good retirement or positive retirement, or do you have some doubt? And I think pretty much everybody has doubts, especially with as much as the federal government is playing with things, and the taxation is going up, and the inflation's going up, and all those things are going to be detrimental to our retirement prospects are all unfortunately enforced now, and not in the foreseeable future going to get any better. And the other question we typically ask is if we could show you a way to get out of debt in 9 years or less, including your mortgage, without spending any money, would you want to listen? And the reality is, when we look at these programs, and I've done hundreds, if not, I don't know that I'm at 1,000 yet, but I'm up there. The 9 years or less piece, it's actually a little bit different. It's not just 9 years or less. It's what I see is 15 to 27 years early, because I've seen someone with 30 years of scheduled debt work a program that gets them out of debt in 2.3 years. So it's out there. It can happen. It just depends on how aggressive you want to get with your program. But 9 years or less is a pretty good barometer. The reality is 15 to 27 years early is what I'm saying. So let's move on. So if you look at the average American, cross section of Americans, you're going to see that we spend an inordinate amount of money on interest and taxes. We don't have enough money left over for our lifestyle. That's putting food on the table, paying the power bill, paying the gas bill, going out to eat with your spouse, maybe taking the kids to a theme park, those kinds of things. That all comes out of that very small piece of the pie, that 23% piece. And then finally, and this is where the problem really lies, we're only saving about 3% of our income for retirement. So to put that in perspective, let's say that you make $100,000 a year and you save for 30 years, and you save 3% of your income for 30 years, and you always made $100,000, which you know is not the case. If that were this scenario, then in 30 years, you would have saved 90,000 plus interest. That's less than 1 year of income at your current income level. This is the problem. And these problems are made worse simply because we're paying too much in taxes and we're paying too much in interest. So if there's a way that we could eliminate some of that stuff and we could show you how to do it, wouldn't that make sense? And that's probably why you're here. So if I take a cross section of the American population and we look at what the average American makes in their lifetime, about $2 million. That number is about 4 years old. So it's a little bit higher now in theory. If you're working and making $2 million, and then you only save $60,000, that's 3% for 20 years, and you only save $60,000, you're not going to have a very good retirement. More importantly, you're probably going to be banking on Social Security to provide the lion's share of your income at retirement. And the problem with that, if you want to call it a problem, it's definitely not a good thing. They just announced that they've extended Social Security so that it will not be defunct in 2034. They've made it go to 2035 now. And so you got one more year, and they're going to reduce the payments down to 75% of what you were expecting. So not only is it still on track to be defunct, it's on track to be defunct at a lesser payout rate than it was before. So we all know this is something they can't let fail. They're going to have to rescue it. So the only way they're going to be able to rescue this is really to increase taxes, or ask the politicians in Washington to spend less money. And we all know that's not going to happen. So unfortunately, we're stuck kind of between a rock and a hard place. So that means we need to look other places. We need to not rely on the federal government, not rely on the goodwill of the federal government or your state pensions to provide income to you. And if we look in the grand scheme of things, going back to the 1970s, the whole idea of a 401k developed by Ted Brenna, the concept was to provide, when the interest rates were high, 14% back when that came out, when the interest rates were high, it was to provide a pension program for people that worked at corporations that didn't have pensions, or for corporations that offered pensions to have an alternative. That's what a 401k was supposed to be. It was supposed to be profitable if the interest rates were high like they were. They are not. Even though we're having high inflation right now and the interest rates are going up, they're not anything like they were back in the 1970s. And Ted Brenna said this about 6 months ago. He said that 401ks are not what they were supposed to be. They are not working out the way that he designed them, and he does not recommend them, especially considering the amount of governmental intrusion and taxation we have on them. And the thing that he recommends in place of a 401k is this, an infinite bank. So thank you, Ted Brenna. So if you go talk to somebody, if you've got some debt and you go talk to somebody like a credit counselor or a debt negotiator or a debt consolidator, they're going to use these 6 bullet points as ways for you to get out of debt. Every single one of these can work. Most of these will not work, and each one has its own pitfall. The only one that really works here is the debt snowball, with consistency. So the debt snowball is the thing that we kind of focus on. You can only work harder for so long. You can only spend less money for so long. You can only save more money if you're cutting somewhere else or you're going to get in a second job. Refinancing, to me, that doesn't make any sense. Why would I want to take a whole bunch of debt and refinance it for a whole bunch more debt? And then finally, consolidation. Why would I want to take a bunch of piles of small debts amount of money and make one big pile of debt that's even harder to eliminate? So those first 5 things don't work consistently. The debt snowball, the thing that we do focus on, does work as long as it's a true debt snowball. Most of the time, what people think of as a debt snowball is actually what's called a debt stack. And in the grand scheme of things, if you run scenario after scenario after scenario, you'll see that a debt stack is only going to be as efficient in eliminating debt one time in a million as a debt snowball. So why do a debt stack? And if you're guessing what a debt stack is, for those of you that are Dave Ramsey fans, go check out Dave Ramsey. That's what he teaches. It's a debt stack. It's not a true debt snowball, and it doesn't work all the time. Actually, it will work. It just won't work as efficiently as a true debt snowball. We'll talk about that a little bit more in a minute. So our better way that we can do these things is through the use of a debt-free life program or a Symmetry infinite bank. Okay, they are one and the same thing. There is a misconception out there that in order to do one of these programs, you need to have debt. That's not true. There's a misconception out there that if the only debt you have is a mortgage, the program won't work. That's absolutely not true. So these programs work with any amount of debt or no debt. And then we'll talk about this in just a second. But what these instruments really are, what this program is, this is a financial instrument. Okay, and all financial instruments work the same way. Maximization, accumulation, distribution. We'll get into that in just a minute. But that whole process that we're going through, the better way, eliminating your debt in 9 years. If you're going to have a retirement, how's your retirement going to be with debt versus without debt? And it's going to be a hell of a lot easier without debt. All right, so let's move on. So what our goal here is to get you out of this scenario where you're on the left side of the screen. We want to get you to the right side. We want to make it so that you're not paying 34% interest, where we can reduce it down to 22%. That's over time. We want to make it so that we're going to reduce the amount of taxes you pay over time. It's not going to be an immediate thing, because the tax savings that we're going to get is going to be in the back end of the program, really. Okay. But it's still a 25% reduction in the amount of taxes you're paying over time. Where's that money going? Yep, it's going right in your pocket. And then also, we know when we structure these programs, we know that if we make you or put you in a position where you have to spend more money now in order to execute one of these programs, that it's probably not going to stick, right? So our goal here is to find money that you're spending inefficiently, repurpose it, so you're without you spending any more money than you're spending right now, and get you to that point where we can change your lifestyle, where we can have that 43% income change, 43% amount of the money increased in what you have to spend on your lifestyle. And then finally, and this is the kicker, this is the most important part of this slide. The most important thing is we want to increase the amount of money you're saving for retirement by 500%. And this is without you spending any more money, without you going out and getting a job, without you getting a third job, going to Walmart, working as a greeter on the weekends, or whatever it is, just to make some extra money, without you going out and driving Uber, whatever. We're just trying to put you in a situation where you don't have to do that. We can still eliminate your debt. We can still get you a nice, solid retirement. And if you start, and I'm going to plant this little seed here now, if you start this program and you get to the point where we're talking about mortgage chunking in a little while, get to the point where you can mortgage chunk your mortgage away, then you're in a perfect position to create what's called an annuity stack, that's really hypersizing your retirement. So I'll touch a little bit on that a little bit later, but I wanted to make sure you got this slide because this is an important slide. So how are we going to do this, right? So we had bullet points before about what your debt counselors, your debt negotiator was going to tell you to do. Well, this is what we're going to tell you to do. We're going to reduce the amount of money that you pay to your lenders. We're going to reduce the interest. That money that you're saving in interest is going right in your pocket. We're going to reduce the amount that you pay in taxes over time. That money you save that you're not paying in taxes is going right in your pocket, or in this case, going right into your retirement program. We're going to improve your cash flow, because we know that if we have a decrease in cash flow, your program is going to fail and you're going to quit. So it can't do anything but stay the same or increase. So we're going to increase it. We're going to allow you to retire with a tax favored income. From my perspective, the best tax favored type of income is a tax exempt income. And that's what we're going to do. We're going to take advantage of 3 different separate IRS tax codes: tax code 101J, tax code 7702A, and tax code 162 if you happen to be a business. And then finally, we're going to eliminate all your debt in 9 years or less. Again, going back to that original conversation, 15 to 27 years early is what we're really going to do. So one of the reasons why all those other programs that we talked about, the HELOC method, the IUL method, let's talk about the IUL method. Why does that one fail? Well, all you have to do is look at the stock market right now and you can see why it fails. Okay, because the IRS, not the IRS, but the market has had a 20.2% drop since January the 1st of this year. We're projected to have another 15 to 18 point drop between now and next August. How's that IUL performing right now? Index universal life, it's not performing. So that means if you were doing one of these programs using an IUL, you'd be 2 years behind the gun. You wouldn't have lost any money, but you certainly wouldn't be gaining the way that you'd be gaining with a par whole life program. Let's talk about a HELOC method. So a home equity line of credit methodology to use as a private bank. Why does that one fail? Primarily because you're giving away equity, potentially risking equity in your home, which the goal for most of our folks here is to eliminate their mortgage. You're not eliminating anything. You might be changing the interest rate a little bit, but you're not eliminating anything. And the other thing is inconsistency within a HELOC or variability of a home equity line of credit. Those are built on adjustable rate mortgages. And I heard a horror story the other day. Guy did one of these with a HELOC, maxed out his HELOC. The bank just called the note, and they can do that, right? So you've lost control and you've given away potential equity in your home to try to eliminate some debt. It's not a good idea. And then finally, that sweeps method. It's a very expensive piece of software that doesn't get you a very large gain. The maximum gain you're going to get from that's about 1.5%. So it's not worth doing that sweeps campaign either. So taking all that into consideration and various reasons why they all fail, we have something here that's different. And what's different is because we're accessing what we call the 80-20 rule. And the 80-20 rule is simply this: we're gonna save about 20% of the money that you have in your program. We're gonna hide it from you. All right. Not really. It's there. You can see it, you can access it, but it really is, it's not easy to access. So we want to make sure if you need to gain access to that emergency fund, because that's what it is, that it's really an emergency, not a, I need to take an emergency trip to Tahiti, not a, I need a brand new jet ski emergency. I mean, a real emergency, right? Because if you actually access those emergency funds, what you're actually doing is you're closing the program out. Okay. And there's some potential tax issues there too. You got to worry about depending on your age. So how does this compare to other investment vehicles? So one thing I just want to say is this: I've talked previously about the S&P 500, and I've talked about 401s, 403s, 457s, Kias, SEPs, traditional IRAs, and all those programs that use the S&P 500 as the benchmark for investing. And here's the dirty little secret: all those programs that use the S&P 500 as an investment benchmark, they're banking on the S&P 500 having an average return of 5.6% over the last 20 years, which is what on paper it is. The problem is most of the time those programs are taxed programs. So when you take out taxes, let's say you live in California. Okay, if you live in California, your income tax rate just for California is 9.3%. So if you take that into consideration, short-term versus long-term capital gains tax in your IRA, take that into consideration, then the actual realized return on the S&P 500, if you live in California and its recent gains, it's 1.79%. So if you have a retirement program that's built on withdrawing 4% per year, your quote unquote permanent retirement program is not permanent. So that's why these programs shine, because of the tax exempt nature. And this next slide talks exactly about that. If you take into consideration a standard investment size, a unit size of $10,000, and you invest it into 3 different vehicles: 1, a tax exempt vehicle; 2, a tax deferred vehicle like a 401, a 403, or 3, an immediate taxed vehicle that's very safe, very secure, very conservative, a CD. This is the result that you can expect off that $10,000 investment over 28 years with taxes being paid. So in all 3 of these cases, it's the same investment size, $10,000. In all 3 of these cases, is for the same length of time, 28 years. In all 3 of these cases, it's assuming an average of 7%. Now for that CD, that's being very generous. You're not going to get a 7% return on a CD. And then finally, all 3 of these are assuming a 25% tax rate. That's not realistic either. We all know that taxes are going up. They're going to have to go up in order to rescue Social Security. We talked about that a few minutes ago. Assuming you can get a 25% tax rate, then the result, it's just math, folks. You cannot outperform in a 401. You cannot outperform in a CD. You cannot outperform in any vehicle where there's taxes involved, because as you're growing whatever tax exposure you have and you're growing your principal, this is eating away at what your gain is. Where in this case, if we're in a tax exempt vehicle, then it's very clear. So let's move on. I talked a few minutes ago about all financial vehicles and how this is a financial tool, a financial instrument, and how all financial instruments follow standard methodologies: maximization, accumulation, distribution. In our parlance for this particular program, maximization means we get you to the point where you can save as much money as fast as you can for your retirement. And the best way to do that is to eliminate taxes and to eliminate interest. And the best way to do that, eliminate debt. Okay. So the interest is the killer here. We definitely have the ability to control that. But once we get you out of that place where you're paying debt service to your debts, and we get you to that place where you are debt free, right? That means that from that point forward, the rate at which you grow your retirement program is completely in your hands. You have complete control. That's where we want you to get to. That means that you're entering into the accumulation phase. Earlier, I talked about some of the misconceptions about infinite banks and about the debt-free life program and about how, I've heard some people say you can't do it if all you have is a mortgage. No, it just means that it's going to take you a little bit longer because the mortgage is a much larger debt to hack off than it is for a good example is you have two separate people with $200,000 of debt. One person has a $200,000 mortgage. Another person has a $150,000 mortgage, $30,000 car payment, and $20,000 in credit cards. They both owe the same amount of money. The person with the number of debts, that's the key here, number of debts, is going to eliminate their debt faster. Person A, on a 30-year mortgage, we'll get them out of debt using a debt-free life program. If that's the only debt they have, 15.4 years. Person B, with 5 debts, 3 credit cards, a car, and a house, that person's going to get out of debt in about 10 years. 7 debts is a magic number, people. 7 debts, it doesn't matter what they are. If you get to 7 debts, then that's where the program is going to shine. At that point, for every debt you have after that, the program will still work. It's just you will not increase the rate or decrease. You will not increase the rate that you eliminate debt as fast as with just 7 debts. All right, so now let's move on. This is not a new program. This has been around for well over 100 years. So if we talk about the people that did these programs originally, yeah, these guys that you see on your screen right now, these are new to the game. These programs started back in the early 20th century, back in 1904. John Rockefeller did one of these programs originally. I won't say he came up with this, but it's certainly an interesting idea that I can put money into a program, borrow against it. I still have my money. I still have life death benefit. And he actually did it for wealth creation and for legacy wealth creation. So he would take money out of his program and dump it and start another program for one of his grandkids. So what that did was it took a small amount of money and put it into a situation where it was going to have 65 years of compounding. So he basically would set his grandkids up to be multimillionaires for a small amount of money. And that's the effect of compounded interest. Walt Disney did this when he built both Disney World and Disneyland. He used this as a tool to sequester cash and to pull money from it and then cycle through the dollars. We talk about dollar cycling. That's what that is. Doris Christopher used it when she started Pampered Chef. Ray Kroc did it when he first started his first McDonald's units. Warren Buffett still does it to this day. It's a perfect tool. And actually, if you follow this in the media, Bloomberg did a big story about this about 6 months ago about how the wealthiest segment of our population are rushing to these programs. Dan Bongino did a big story on this about 2 months ago. Same thing, how the wealthiest segment of the population. We see right now, I saw a report today, there's a mass exodus of money coming out of the market. And it's going into these programs because it's stored and sequestered and protected from IRS intrusion. It's tort proof. I can sue you for anything I want to. I can sue you because I don't like that pink shirt Zach Little's wearing. Okay, I don't have control over that, but because it bothers me, I can file that lawsuit. I won't win, but I can file the lawsuit. And if you lose the lawsuit, then a judge can order you to liquidate assets. This is not an asset they can order you to liquidate. It is tort proof. Let's move on. So ultimately, the idea is that we're going to harness the use of a life insurance policy because of some of the IRS tax benefits that are in the tax code. We are not breaking the law. We're following the law. Okay, so there's something I heard a couple of weeks ago. The wealthy use the tax code. The wealthy and the educated use the tax code. The unwealthy or uneducated pay what the tax code tells you to pay, right? So this is all about playing within the rules. We're not trying to do anything nefarious or wrong. We're playing by the rules that they set. And incidentally, one of the pushbacks we hear a lot about this is, well, what happens if they change the rules? Well, that's great. They can do all they want, because as soon as the policy is issued, it is issued under contract law at the time of that contract law. So even if they change this and make the whole thing taxable in the future, doesn't matter, because contract law at the time the contract is struck is what governs the contract. So this is all stuff we've already talked about. That legacy is a huge piece, which is really important to us. We started doing this, we started talking about this in 2018, actually started executing these programs in 2019. This is Symmetry's Debt-Free Life program. And these were some of the first families that we executed these programs for. And it's not rocket science, it's just math. It really does work if you follow the plan and follow the program. That whole piece here from a wealth growth perspective, especially if you're in your 40s to 50s, there's plenty of time to execute one of these programs. It's not too late. When you hit 65, 70, then it becomes problematic. 75, it's too late. So let's talk about how you spend money. And this is the kicker. So right now, we are taught how to store, save, grow, and spend money, unfortunately, by the banking industry. And it's in their, it behooves them to not show us how to get out of debt, but to show us how to get into debt. So here, let me give you an example of that. So right now, the way you spend money is, if you're a traditional American, you make your money gets deposited into your checking account. Doesn't matter who you bank with, whether it's a credit union, Citibank, SunTrust, whatever. You put your money in your bank account. And as your money sits in that bank account, the bank uses that money over and over and over again. And they're executing a process called arbitrage. They are borrowing money from you at a lesser interest rate than they're lending it out. So every night they're able to lend that money out at the federal funds rate. That's what the Fed's doing. They're changing the federal funds rate recently, once a month, and it's going to keep going. The average dollar that you put into your checking account is spent 7 times by the bank before you actually get to use it. The average dollar that you put into your checking account makes that bank 61 cents. And the average amount of money that that bank gives you for the use of your money is 0. That's positive arbitrage, people. So finally, you go through your bill pay, you write a check, whatever it is, and you tell your bank to pay your debt, and then your money becomes your creditor's money. That money's gone forever. And even if you're super sweet and super nice and you know all the right people, that money's gone and they're not giving it back. It's their money now. It's not your money anymore. And you've had the money and you've used it exactly one time. So in this scenario, you've made the money, you put the money in your bank made a lot of money with your money, paid you nothing for it, you transferred your money to your creditor, and you used your dollar one time. That's how the banks want you to spend money. That's what they teach you. There's a better way. This is our way, the debt-free life method. Same process. You make money, gets deposited into your checking account. Here's where we differ. And this is where the rubber really meets the road with this program. We actually take and make a premium payment to our life insurance policy, which happens to be a whole life. And that's important. It's not just any kind of whole life. It's called a participating whole life. And what that means is, because it's participating, we are able to participate with the profitability of the company that writes the policy. So if you have a whole life insurance policy, I'm not going to name any names, but if you have a whole life insurance policy that's a traditional whole life insurance policy that is not participating, you're going to have cash growth. And the return that you might get might be 1/10 of 1%. Okay? Really, really bad. Worse than a savings account. When you're making your premium payment to your whole life policy, one payment, right? That payment's actually broken up into 3 parts once it hits the carrier. The 3 parts are these 3. Part of it goes to pay for the whole life underlying core policy. Part of it goes to pay for a term life rider, and the majority of it goes to pay for a paid up addition rider. So if you look at the standard split that we try to do here at Symmetry, 60-40, 65-35, 68-32. I'm going to use the 68-32 split as an example here. So in this piece, the whole life component is 21%. The term life component is 11% of every premium payment you make. And the paid up additions rider is 68%. More than 2/3 of every penny you send to the life insurance company on a standard split here at Symmetry is going to grow cash. Paid up additions, right? Let's talk about that. What does that mean? So what is a paid up addition rider? A paid up addition rider is nothing more than additional life insurance, okay? But it's special. It is life insurance that is considered an asset. It's considered an asset by the banking industry. It's considered an asset by the insurance industry. It's considered an asset by the hedge fund industry. It's considered an asset and should be by you. Why? So let's talk about what is an asset. So an asset, a dollar bill. I have a dollar bill. Is that an asset? Yes. Okay. I have my favorite coin collection. Is that an asset? Yes. What's the value of my coin collection going to be in 2 years? I have no idea. What's the value of that dollar going to be in a year? $1. Okay. So a paid up addition is a paid up life insurance that the IRS, and here's the key, the IRS sees as life insurance, but the carrier sees as cash. So when the carrier is looking to apply the guaranteed interest rate, remember this is participating whole life. When the carrier looks to apply the guaranteed interest rate and a dividend, if this is a mutual company, right, then they're looking at what the cash value of your program is. And paid up additions, being that it's an asset, the carrier considers that as cash value. So if you sent $1,000 to your policy, $680 is how much is credited towards cash value. More importantly, you also increase the death benefit. So let me explain a couple things. Why do we have a term life rider? The term life rider, initially, what it does is it increases the total amount of death benefit. What that does is it acts like an umbrella. So when the IRS comes snooping around and they want to see how much cash value you have versus how much death benefit you have to determine whether or not your program is a MEC, a modified endowment contract, and taxable, that's what they're looking for. So if I've got this large term rider, $1 million, and I've got a whole life policy, 100,000, and I've got $500,000 in paid up additions and $500,000 of cash value, that $1 million of life insurance on that term rider is acting as an umbrella and shielding all of this initially. Eventually, over time, what happens is the paid up additions rider grows and grows and grows, and we don't need the term anymore. Okay, so that's the relationship about how those three prongs of a participating whole life program work. And that's the purpose of each one of those things. Remember that emergency fund I told you about? It's hidden, right? Where is it? It's hidden as cash value, true cash value, not paid up additions, true cash value in the core whole life policy. And if you access it, the only reason you're accessing is because you want to cancel the policy. You want to get all the cash out. And if you do that, you're making a huge mistake. Okay. Probably depends on your situation. So now let's see if you remember that last screen where the bank was making money every night with your money over and over, lending it out at the federal funds rate, making 61 cents with every dollar and paying you zero. We've changed the game. We've moved the money now. And now we're making money in our private bank, in our infinite bank, in our DFL bank. And now we're the ones making the money. Okay. So how do you use this in conjunction with the debt snowball? So if I have, oh, by the way, paid up additions are considered what's called a tier 1 asset. Banks have 4 asset classes that they have to keep on their books to allow them to continue to lend money out. A tier 1 asset is a very safe, very secure, very conservative investment. 2, 3, and 4. 4 is a very risky, very unsecure, and not a really good idea of an investment. A tier 1 investment would be things like gold, precious metals. You don't know their exact value because they fluctuate, but you know they always have value. Tier 4 asset, that would be like lending a 21-year-old busboy $1 million to go open a restaurant. Pretty bad idea. Not going to turn out well. Okay. So at this point, now I've got to the point where I want to pay off a debt. So let's say my debt is my car and I want to take $1,000 and I want to pay off my car. Do I take money out of my program? No, I take a loan. I use my paid up additions as collateral. I take that $1,000, I put it back into my checking account. I tell my regular bank, Wells Fargo, Bank of America, Citibank, whoever, to go ahead and pay my debt and transfer that $1,000 to my car company and pay off that note. So let me ask you, in the previous example, my money was used exactly one time. It sat in the bank made money with it. Then I transferred that money from my bank to my creditor, paid off that debt, used my money one time, made $0 with it. In this example, I'm taking my money in the form of a life insurance policy. I'm putting it up into my private bank, which is earning me 3, 4, 5% or more guaranteed return, plus a dividend because I only use mutual companies for this. So the dividend's coming in on top of that. And then I'm borrowing against that, putting the money back into my checking account, telling the bank to pay my creditor and paying off that debt. Does my creditor care where the money came from? It does not. They just want to get paid. Does my bank care that I told them to pay off my debt? No, that's what their job is. Their job is to transfer funds and store funds. They're not too happy that I'm making money with my money and they're not, but I don't care about the bank things. If I'm taking a loan against the value of my paid up additions, am I using my money? Nope. So in this scenario, what is my gain? All right. So my debt, $1,000, is paid off. The cash that I used as collateral is still in my private bank. My gain is 100%. The debt's still paid, that's gone. My cash is still in the bank, earning interest for me, earning a dividend for me every day for the rest of my life. My gain is 100% or more. Okay, depending on the length of time you've got the money in the program. So this is what I'm talking about being able to use your dollars over and over and over again. I'm making the money work for me. I'm not working for money. Money's working for me. And that's the nature of a debt-free life bank. That's the nature of an infinite bank. That's the reason why the wealthiest segment of the population are doing this. And heaven help you, if you are an individual that works as a 1099 and you're paying your taxes, why in the world would you use the money to pay your taxes one time? Put your money into a private bank. Let it sit there and earn interest for you for the rest of your life. Take a loan against it, pay the IRS. The IRS doesn't care where the money came from. They just want to get paid, right? That's what's called a secondary funding strategy. We're not going to talk about that right now, but that's another use of a private bank. This is a Swiss Army knife of financial instruments. You can use it for all kinds of stuff, right? You're only limited by your imagination, right? So get with someone, preferably from Symmetry, who knows how to do these programs and talk about it. Have a conversation, right? All right, I'm going to show you a couple illustrations, then we'll move on. So this is a family. This is you guys see my debt-free life screen? Okay, very good. All right, so this is a family that I met with. I just met with them 2 months ago, just on an update. This is one of the first programs that I did back in 2019. They had a tremendous amount of debt. All those debts: student loans, car loans, personal loans, back taxes, medical bills, 3 properties, crazy amount of debt. When I asked them how much they owed, they said they owed $584,000. When you compute the scheduled interest, nope. The actual amount they owed was $767,000. Right? So $182,000 of scheduled interest. If I can change the amount of interest they pay over time, and this is, look at that, 40 years. Why? Because the woman at this time was a PhD student. She had a tremendous amount of student debt, and student debt is evil. Student loans are evil. Okay. So these are the student debt's golden handcuffs, right? Yep. Here's your piece of paper. Now go work for us for the rest of your life. That's student debt. So if we can do something to change the game, should we? Of course. So here's what we did. We got them out of debt in 7.8 years. From 40 years to 7.8 years. So that's great to eliminate the debt, but really, what does that mean for their family's future? That means that instead of having nothing but equity in 3 houses in 40 years, which is what it was going to take them to eliminate that debt, now they've got equity in 3 houses. We've eliminated $70,000 of interest. And oh, by the way, the money shot. We've created $4.8 million of wealth. So this is, again, I say this all the time, this is not rocket science. This is just math. Okay. And that math, that 40 years, where they would be in 40 years without this program, is debt-free with equity in 3 houses as a retirement, living on whatever Social Security they had and whatever other pensions they had. Where they're going to be here in 40 years is debt-free with 3 equity houses, the equity in 3 houses, their whatever Social Security they have, whatever pension they have, and $4.8 million. I think the last option is a better option. Okay. So now let's take a look. Let's get down into the deep part of this. What does this really mean? So in this scenario, each one of those yellow bars represents a year in which one or more debts were paid off. If you remember, this particular family had like 12 or 14 debts, right? So we're paying it all off by the end of the 8th year. A couple things I want you to pay attention to. Do you see in year 10? In year 10, they are completely debt-free. So in year 7.8, they're borrowing $177,000 from the program to finish off their last house. Actually, it was a student loan, I believe. No, it was the last house. And then by the end of year 10, that loan is paid off. They've paid themselves back. They've replaced the money that they borrowed. And then I want you to look at this growth. From year 10 to year 11, from year 11 to year 12, it's growing 485 to 600. That was $115,000 of cash value growth in 1 year with 0 debt. So this gentleman at the time we did this was 36 years old. He told me he wanted to retire at 75 years old. This was one of my first business programs as well. This gentleman is a trucker, and he had a design to build a trucking company, and he wanted to buy a new rig about every 4 years. With this program, he's actually able to buy our new rig twice a year. That's not illustrated here, but that's the end result of what they're going to do as soon as they get debt free, which they're actually going to stop the debt elimination on the 3 mortgages, and they're going to start buying trucks. Okay. More importantly, he said he wanted to retire at age 70 and so we did that. We looked at the numbers, but I can get him retired at age 55, 15 years early with $1.5 million liquid. $1.5 million liquid is going to generate about $125,000 a year. If it's through this program, it's generating that in a tax exempt manner. That's the equivalent of $175,000 a year taxable income. At that point, you stand up, take a bow, drop the mic, and say, sign here. And that's how you do it, right? So there's other options. You don't have to have a mortgage to do this. This is an example of someone who doesn't have a mortgage. I won't get too deep into this. I just want to say this was a 23-year-old girl student. When I met her in her master's program, she had a lot of debt. Most of it was student debt, and I want to illustrate how evil student debt is here, right? So she owes $85,000 at the time we did this illustration. Her true debt, because of the interest on her student loans, was $91,000 of interest on student loans. They are evil, people. Yep. So if you have children that are going to go out and take student loans, do not co-sign for them. Don't let it screw you up too. Okay. But do everything you can. There's a process. I know Ruslingo is working on this stuff. There's a process out there where you can actually eliminate student debt as you go. And it allows you to take out the student loans, but not have that deferred time when you're going to have this massive amount of money that you have to pay back later on. And that's using a different vehicle, but that's another really cool tool that you guys should be taking a look at. So with this particular person, this girl, we got her out of debt with all of her student loans in 9.7 years, saved her almost $65,000 of interest. And we put her in a situation where she could retire at age 63 with $603,000 in the bank. This is assuming that she never makes any more money than she was making at the time we did this, which she was a waitress when we did this. Nothing wrong with waitresses, right? They work hard. But we know that's not the case, because at this point she's getting a PhD, and she'll be making a lot more money than she was with this. I think the only concern she's going to have at this point is that she didn't make the program large enough to accept enough money. So she can go back and do another one, right? All right, so that's kind of the end of this presentation. So where you go from here is up to you. If you're here as a client, great. Get with whoever invited you, get up with them. This was supposed to be kind of an introductory presentation about how the debt-free life program works and what it is. If you're an agent, broker, underwriter, and you want to get more into this, great. Talk to your upline. Go get your certifications, become a subject matter expert, be that person for your team that people can shuttle these to you. All right. So I'm going to stop for a second and let's open it up. All right. In the middle of my screen is Jared Thunder Reinecke. Hello, Mr. Reinecke. Nice to see you, buddy.
How's it going, Scott? Good to see you.
Yeah, man. So I see there's one thing in the chat. So you guys got everything we were talking about, and it says we're jamming. There you go, right on. So we got no questions. Fantastic. Hello, Mr. Deutsch. Nice to see you. Does anybody have any questions before we move on? And I want to introduce our next our special guest. Anybody have any questions?
I have a question.
Yes, sir. Go ahead.
Yeah, great presentation. Thank you for that. I just couldn't understand the concept of when you said from the DFL bank, when you borrow against, I guess you take out the money from the bank and then transfer to your bank. Like that's the concept,
right? So here's the first misconception. This happens all the time. You never take principal from your DFL bank. You don't do that. If you do that, the first time you do that, you're probably going to cancel your policy. You take loans against the cash value, but you don't take the cash out. Okay. Yeah. So as long as you do that, then the bank becomes, if it's structured correctly, it'll be perpetual until you pass. And that's why Rockefeller did it the way that he did it, so that he could create perpetual wealth, which is exactly what he did for his family.
Okay. And the amount of loan that I can take depends on the cash value I have.
Sure. Right. So with most of the carriers that do these, they'll allow you to take a loan of up to 95% of your cash value. I'm going to make a recommendation that you don't ever encumber more than 90% of your cash value.
Okay.
Okay.
Thank you.
Yep. Anybody else?
I got a quick question, Scott.
I might have an answer. Might even be right.
Yeah, I know you got the answer. You talked about dropping the term once you got to a certain point where your cash value was enough that it would kind of be a percentage of your death benefit and not MEC. What is that percentage usually?
So
25%?
It depends
50%?
on the structure, and it's something that maybe you don't do on a schedule, but I would say usually you're going to see that around year 7.
Okay.
You know, depending on it, also there's a lot of factors here. It depends on how much you're funding it, how much you're overfunding it. If you had money coming in the beginning, there's a lot of pieces here. All right. So I hate to say I don't know, but I don't know, because each one of these cases is different.
But yeah, it makes sense. Right around year 7, it looks like it's been there for a long time. Got you.
Yep. I see Marc Barnes shaking his head up and down. So it's almost like I said the correct answer, right, Mark?
Yeah, it is. And Scott, if you don't mind me adding something to that.
Go right ahead.
One of the main reasons, Zach, why that works around year 7 is because the IRS MEC test is a 7-year test. So that's part of the reason why it works. Yeah, it works around year 7. But like Scott said, there's many variables that play into that. I mean, you could be looking at 2 females, both age 35, and depending on the structure of the policy, that MEC limit could be completely different for both of them.
Yep. So Teresa Sackman asked a question about long-term care. This is not an asset that will affect your ability to receive long-term care. This is life insurance. Okay, just like there's another strategy here when you're looking at getting college funding, securing like grants and stuff like that. If you have $200,000 sitting in your checking account, it's probably going to keep you from getting a grant for your child. But if you put that $200,000 into a life insurance policy, then it's not considered cash value and doesn't go against your calculation. So it will not keep you from getting that college funding. All right. How do you determine whether to go with a 20-year term versus a 10-year term? All right.
Mr. Forehand?
Yep.
Aaron Weaver, because I want to piggyback on that question that you just answered.
Sure.
I'm very clear on that. I had a question that somebody asked me today that I couldn't answer. What about if they owe the IRS money? Can the IRS come after this?
Can't touch it, tax it, or see it.
Okay,
Yeah,
perfect.
and
Thank you
a
for letting me
federal
interrupt.
judge
Appreciate
yeah,
you.
so part of that goes to the whole idea and the whole design that these are tort proof. So in order for the IRS to come to you, they're going to have to file a claim in court. Okay, in order for them to file a claim in court, it's got to be something that's winnable. And that means that the judge that hears that case is going to have to be able to potentially order you to liquidate this, and they can't. So that's why it's tort proof. All right. There was a question.
I can, hey, Scott.
Yep.
Scott
Hey,
Simpkin
Mr.
here.
Simpkin.
I got it. How's it going?
Good. Good to see you.
Great presentation. I love this. This is so good. No, I don't care how many times I see it. It's fantastic. I really.
Glutton for punishment you are.
I tell you. Well, what can I say? As far as the whole non-taxable, non-attachable type of thing, I've written these for people that have fines they have to pay for felony convictions, for federal taxes,
Who are you
all
hanging out with,
kinds
Scott?
of other stuff. Well, you know, I don't write them on them. I write them on their spouses, but they use them for that, and they've paid them off. And guess what? Uncle is very happy. He doesn't give a damn where the money comes from. Just
Yep.
pay him off.
That's correct. And I have it on good authority that the companies that we use for these, they don't care what you're using the money for.
Imagine that.
Your money, right? Win-win. All right. So I did want to get to that one question. This is from Jeremy talking about a 20-year versus a 10-year term. So at the end of the day, it's a math calculation. All right. So if you look at, it depends, each program is different. If you've got someone who's 50 years old and they're at the last year of eligibility to get a 20-year term, you have to look at the cost of that 20-year term and look at when you're planning on stopping the term. Okay. So if they're planning on stopping it in year 12, 13, 14, or 15, then the 20-year term doesn't make sense. If they're planning on stopping it in year 19 or 20, maybe. So part of it is just look at the math. How much does the term rider cost for the first 10 years? And then the second 10 years, do the math of when you think they're going to stop, and then figure out how much you're going to pay over time. That's how I do it. Do you have another suggestion, Mark? Does that make sense to you?
It definitely makes sense, Scott. And the only other factor I would play in there, especially when you're, you have to consider the carrier as well. But you're spot on. It really comes down to how long does your client want to pay into this? Because if you have a client that's younger, let's say 35, with mutual trust, they qualify for 3 level 10-year periods of that term rider, or 30 years. The challenge with that is, although it is less expensive compared to a 20-year term, you are going to see a cost of insurance increase at year 11 and year 21 because of the client's attained age. So you also have to factor that, right? That the cost of insurance is going up slightly. Now, if you have a client that's not a big fan of that, and I don't mean to get into the weeds, Scott, there's ways to offset that increase through the PUA rider to keep those premiums level. Or, like Scott was saying, you got someone that wants to pay into it for 19 or 20 years, use the 20-year term so that your premiums remain level for that whole time.
Right. So there's a couple of factors here to determine which way is the right way to go. Ultimately, you have to do the math, and you should present options to your client. Let them decide. You shouldn't make the decision for them, obviously. All right. I think there's one more question. Nope, a couple more. Okay. So let's see. It didn't get a chance. This is from Mr. Syed. Didn't get a chance to read much about this concept of infinite banking online, but Dave Ramsey apparently thinks it's a scam. Right. Well, I've done a presentation on Dave Ramsey, and I know his is a scam.
Absolutely.
Yeah. Right. Yeah. Dave Ramsey. So just a little glimpse into Dave Ramsey's stuff. Dave Ramsey has people that come in, get trained, get Dave Ramsey certified, and then he gets them out in the field and makes recommendations for life insurance products. These people are not life insurance agents. So because of the way that his business is structured, the field agent, who's not an agent, makes the recommendation, refers it to a life insurance company. Because there's no connection there, the life insurance company is making money, paying whoever, Dave Ramsey, paying whoever a fee, and the fee's not reported. So there's a whole lot of stuff going on behind the scenes that you can't see. And you're being given advice from someone who's trained by a company that doesn't have authorization to train people on stuff like that. So yeah, Dave Ramsey's a scam. Yeah, he is. Mr. Ramsey, don't sue me. Let's see. Question for business versus personal. If you have debts both personally and your business, should you do one program for both or split them up? I would do separate programs. Reason being, with business, there's some additional tax implications that you can, or tax options that you can take advantage of, especially with tax code 162, and you can make a portion of your income flow in a tax exempt manner. Also, if you only have one program, there may be a reason why, for whatever, you never know, but maybe you want to liquidate. And that way you don't have to liquidate all of it. You can keep some of it, whether, if the business is closed, you're no longer in the business, you liquidate the business program, or vice versa. So I would always, whenever you have an opportunity, in my opinion, whenever you have an opportunity to compartmentalize different pieces of somebody's program, you should. It's more work on you. It's more underwriting for the carrier, but ultimately it's probably what's best for the client. Illustrations, here we go. Illustrations based on current interest dictated by the insurance company that can change annually and unguaranteed dividends. How can we be confident they will have X at 8 years? Mr. Sminky, great question. I would say if you are using dividends as part of your presentation, that's a mistake. I always talk about dividends as being gravy. All right. So I use, when I'm doing these numbers and doing the calculations, I'm using 3% if it's mutual trust, 4 for Lafayette, 5 for Foresters, as the base gain. And that's what I'm basing my numbers on. I would say, the dividend should be downplayed, and it should be, if you're, okay, 2 different ways the companies count direct loan recognition versus non-direct loan recognition. There's advantages to both sides of the equation. I'm a proponent of the way that mutual trust does it, because it's easier for me to engineer arbitrage. And I like arbitrage. I like being able to borrow money at a lesser interest rate than I'm able to lend it out. So there's some pieces there. I'm not trying to be wishy-washy. There's a lot of pieces here, but I would say I wouldn't emphasize the dividend when you're talking to your clients. I would de-emphasize it. You got any comments on that one?
I used to be with Your Family Bank way back when, as
Okay.
you saw in the illustration, and we uploaded the CSV file, which automatically included that.
Sure.
I haven't gone through the DFL currently. So there's a way, from what you just said, I can set whatever percentage I want.
So the way that the DFL software for Symmetry works is it actually parses data from the PDF, where the CSV file is where the data came from for YFB software. So there's pros and cons to both software. I know what you're saying about the dividend piece. I also know that intentionally, because I did talk to the developers of the YFB software, and there's an intentional degradation so that over time, the amount of money that they're projecting is actually more conservative than what you should have. So even though their software does bring the dividend into it, it's actually de-emphasized because they're actually suppressing the amount that they say you're going to have at a specific date in the future. The DFL software from Symmetry doesn't do that. It doesn't need to, because it doesn't have a CSV file. It actually pulls the data, the metadata from the PDF. If that helps you, hopefully that helps you.
Thank you so much.
All right. Yep. Yep. Splitting. I agree. Marc Barnes. You should avoid commingling personal and business income. That's right. And there is an advantage to commingling as well. And your CPA will hate you if you do that. All right. So there's this. So I'm going to stop with the chat. Looks like we've answered all the questions. Let's go ahead and have a conversation. So Marc Barnes, thank you for coming.
Absolutely, Scott. Thanks for having me. And I couldn't agree more with whoever entered the chat first. nothing like starting out a webinar with little Superstitious by Stevie Wonder.
Right on, man.
And just a way to get things
Yeah,
going,
buddy.
Scott. Way to get things going. So I just want to say hello. It's great to put a number of faces to some names. I've talked to many of you, from Scott Simpkin to Jay Ferreira to Ruth Marie Slingo to Aaron Weaver, who I talk to, I think, every day, but have never put a face to a name. So it's great to see you guys. And Scott, thanks for having me. Listen, if you're a potential client considering this, realize that you're not doing anything brand new. And what I mean by that is you're not embarking upon, something that just came out last year or is today's hot trend of topics to talk about on social media. As Scott had alluded to, this has been around for hundreds of years. It's just the nature of whole life insurance, and fortunately, the nature of working with a mutual insurance company that offers participatory whole life insurance. But I'm telling you, I don't care if you've got $10,000 worth of debt, no debt, or $1 million in debt. As Scott also talked about, the cash values can be used for whatever reason you need to. We don't even ask why. We just ask how much and where do you want us to send it. And so whether that be college, getting out of debt of college faster than what you're looking at currently, paying off your mortgage, or what a lot of people use these for, is supplementing your retirement income. As Scott kind of kicked off his presentation, are you comfortable with where what your retirement looks like today? If not, then this could be a great way to make up that difference, or to make up what you feel you may be short. As well as there's some other strategies to potentially increasing your Social Security income by delaying taking Social Security, by replacing what you might get from Social Security from your cash value. So that's maybe that's another session, another time where we jump into the weeds. But it's definitely a great program. But again, talk to the person that brought you if this is new to you, or certainly if there's anything my particular carrier, Mutual Trust Life, can do for you or answer any questions, please don't hesitate to reach out.
Right on. So, Ms. Slingo, I thank you very much for coming. We had a little bit of a conversation earlier about this, which was we didn't really have a plan on where we were going to, in particular, talk about anything in particular. But you've got Marc Barnes. He's on the hot seat, but at least be gentle. Okay. So, what questions would you have for Mr. Barnes? Anything in particular that you'd like for him to shed some light on?
Oh dear.
Oh yeah.
Well, great presentation, Scott. I love this. I love seeing everybody on here. I'm so passionate about this. Questions for you, Marc. Really, Scott, really, can you throw me a softball a little
Sure.
better?
Let's talk about two-pay solutions, how they could work.
There you go. Hey, Marc, can we talk about some two-pay solutions and how that might be beneficial?
Yeah, for sure. So I think, and Ruth, great to put your face to a name. We've never met in person, so it's great to meet you, at least in person, if you will. Two-pay solutions, and even a single premium non-MEC solution, right?
Yes.
I love single premiums.
Absolutely. All of this conversation, everything we've talked about today, and anything you talk about in the future, starts with a really great consultation with your client. What are they trying to achieve? How much time do they have to achieve it? What, how much money do they need access to, and by when? For what reason? And then beyond that, what's their longer term goal? After we satisfy this immediate need for this solution, what do they want to do with it? For example, and I'll get back into two-pay and single pay, Scott's been talking about debt-free life. Fabulous program, one of our best programs here at Mutual Trust personally, or as a business anyway. With that being said, a lot of people just are too narrow-sighted with it though. Debt-free life is great, but like one of his examples, we just got somebody out of debt in 7 years. Now what? Do we surrender the policy? No, there's a lot more use to that thing down the road as your life changes. You have a baby, kids go to college, kids now have college debt. You want to set up that kid with their first down payment on their home, or you want to set yourself up or supplement retirement. So so that's just my kind of take on that. But with that consultation, Ruth, determining when this client needs access to their cash value and how much they have available now will kind of guide you as to which direction makes sense. Whether it be a single premium, because maybe they're a real estate investor, they've got 125 grand sitting in the bank, and they need access to the majority of that right away because they want to buy another property or have to fund, some remodeling projects, right? So therefore, a single premium makes a lot of sense for that person. They drop in 125,000. The majority of that's going to be available, roughly 80 to 85% in year one anyway. And they have access to their cash value with mutual trust as soon as 10 days after the policy has been put in force. But let's say they've got a little bit more time to play. Same 100, let's call it 150,000 just to make numbers a little bit easy, but they don't need 120,000 in year one. Maybe they only need 50,000. Anytime you take a lump sum of premium and dump it into a policy for less than 7 years, it's usually going to be better from a return on investment standpoint to spread that out over a number of years. Not always, but usually. But again, what dictates that is your client. If your client needs all of it right away, we got to do a single premium non-MEC. If we've got some time to play with, then a 2-pay non-MEC or 3-pay, 4-pay, 5-pay may work out best for them.
Right on. So from a 2-pay non-MEC to a single pay non-MEC, one of the things that I'm big on is efficiency, right? When I say efficiency, I mean how much of that premium can I capture as cash value? So the best one I've ever been able to do is 96.8% efficient, and that was on a single premium non-MEC. Okay, but from an agent's perspective, we're not making it's okay. We don't have to make money on every deal, but there's not a whole lot in for it. But the single premium non-MEC, it gives immediate access to cash, about 95%. You are whole within 3 years. The piece that you're missing will grow back over 3 years. And as long as it stays in non-MEC, then it's something you can come back to that well over and over and over again, right? So from a non-MEC single pay perspective, what do you see, Mark? What do you hear? What are some of the things that you like? Because I know you're doing these illustrations all the time for folks. I'm sure you hear the stories. This is what I'm trying to do. And what do you hear? What are those uses?
Yeah, so, I think you're right. When you look at efficiency, right, and to break that down a little bit for everybody, you really think about the return on investment, right? If I'm putting in 200 grand, I want to see how quickly am I getting that 200 grand back, right? Or available anyway, especially your clients. We, as insurance professionals, we tend to think a little bit differently because we know all the moving parts. However, your clients are, they're very transactional. They want to know that they're getting the return on investment. So, Scott, to your question, typically I see a shorter return on investment when you spread out that premium. Single premiums, I typically see that return on investment in usually somewhere between 10 or 15 years or less. And usually if we're spreading that out, and it could be quicker, again, as you know, it depends on the design. But generally speaking, in a 2-pay, it's usually less than 10 years, sometimes less than 5 years when they're seeing that return on investment.
Okay. There's a question here. Is mutual trust in New York? I don't think so.
No. So I answered the question in the chat. And
okay.
I just looked and I spelled available wrong. But
hey, Mark.
So yeah, meet the person in New Jersey for coffee.
Right.
I have a question.
Yes, sir.
Okay, so explain how a single premium can be a non-MEC. Because I always thought that single premiums were always MECs. So explain how that happens.
Yeah, great question, Scott. And so the way that happens is that in order to pass the IRS MEC test, it's a 7-year test. And so we have to show a premium for 7 years. Doesn't mean your client's paying for a premium for 7 years. We just have to show a premium for 7 years. So the way that works then, Scott, is we drop in whatever amount of money it is as a single premium, and we use the cash values to pay for the base portion of the policy, which could include base and term, for the remaining years up to 7, so years 2 through 7. That's how we avoid a MEC.
And that's the same way you do it with a 2-pay.
Mm-hmm.
Right.
All right, so that's a call you so you can show me how to do that on the software question, right?
Yeah, it certainly is, Scott. It's actually fairly simple, believe it or not. Now, I'm a little biased. I run, I don't know, 50, 60 of these a day. So probably not that many, but a lot. Right. It is fairly simple. If you want to, if you are agent with us, for anybody on the call, feel free to visit our Agent Resource Center on our agent site, specifically the Getting Started section. The video you're looking for, Scott, is the limited pay non-MEC solution video. In that particular video, we use a 2-pay as an example, but you could use the same steps for a single premium.
Perfect, thank you.
Yes, sir.
Okay, we got 16 minutes left. Anybody else with any questions, or you want to see how to turn a mortgage chunk into a daisy chain stacked annuity? Okay, nobody? All right, very good. All right, so let's go here. All right, so one of the things that I try to go over with our clients, can you guys see my screen? Does it say current debt summary over 20.6 years? Okay. All right. So what this is a client I worked with a couple of years ago. This was his debt elimination schedule without a DFL program. This is his debt elimination schedule with a DFL program, 8.6 years. Okay. So it's pretty strong, saved 14 years, right? And here is this. So let's talk about this for a second. So this is the perfect candidate, and you're going to see this for a lot of folks who have a number of debts, which most of them are smaller debts, but the one big debt like a mortgage. Okay. So in this scenario, we got a couple options here. We can do what's called mortgage chunking, which is when we take money out of our program, in this case, $39,000 in year 5, take out 90% of that, throw it at the mortgage. What that does is it advances, and for this case, for the size of this guy's mortgage, which I think $200,000, that one single $35,000 chunk payment going on 100% to mortgage principal eliminated about 8 years of mortgage payments. Okay, because it eliminated a tremendous amount of interest, but it escalated him through the amortization schedule about 8 years. And then if you look at this in year 2, if we just subtract 39,000 from 61, that leaves an additional $22,000. So in year 2, we could have done another 20,000. And then in year 3, if we needed to, we could have done another 20,000. That would have been enough to eliminate this guy's mortgage. When you're doing a mortgage chunking routine, especially if you see this window, which is about 48 months, there's some math you can do. I'll show you how to do the math. You look at your last payment, which is in month 39, for the loan before the largest note, the largest loan. So that was a student loan, 39. In month 39, we eliminated the student loan. In month 103 on this schedule, we eliminated the personal residence. So if I take 103 and subtract 39, that means there's a 64-month difference between the time we pay off the penultimate loan or the penultimate debt and the last debt. If I use mortgage chunking and the length of time that I want to mortgage chunk is longer than 48 months, which is, this is 4 years right here. So this is longer than 48. In this case, it's 64 months. I can eliminate 16% of that time. So if I take out 16%, that means I can get out of debt in 53 months which in this case is 11 months faster than on schedule. So then instead of being out of debt in 103 months, I'm out of debt in 92 months. That's how a mortgage chunking routine works within an illustration. You can't illustrate it. It's math that you have to do, but that 16% is what you can expect. Now, what I'm going to show you is why it's advantageous in this case not to do that. And that was why here. 39,000, 61,000, 84,000, 105,000, right? So over that 4-year period of time, if I wanted to, instead of doing mortgage chunking, I could actually incorporate an advanced growth wealth strategy called an annuity stack. So if from this, I derived an annuity stack. So annuity stacks are nothing more than a series of annuities that you're taking out at different times of the year so that they are going to be maturing in different months. Because at the end, when you start realizing the income from an annuity stack, you want them stacked up so that one matures in January, one matures in February, one matures in March. And that way you're getting 12 months of annual payments. And the reason why that's important is because I'm an efficiency guy. So efficiency, having an annual payment versus having a monthly payment from an annuity, you get 2.4% more income from an annual payment versus a monthly payment. That's all. And so I'm just making a little bit, yep.
Quick question. When do you have this conversation with your client?
So I have it in the beginning. I mean, this is where my debt-free life presentations, infinite bank presentations, it's not one presentation, it's multiple, because this is something you don't do this for everybody, because it's not appropriate for everybody. But if I've got someone and we're looking at wealth growth and we're looking, it's not just elimination of debt, it's about how I can do this other stuff, then I'm going to take an extra 2 or 3 meetings with these folks to make sure they understand the process, understand what we're trying to do here. So the when is going to be, again, it's particular to the client. You're going to have to ask a lot of questions. And this is something that's a little bit hard to get your head wrapped around. So I can show you a mortgage chunking option like what I just did. And now I'm going to turn around and I'm going to say, yeah, we can do that. And yeah, we can get you out of debt a little bit faster. But at the end of the day, what we're trying to do here is grow wealth, right? And so accumulation, maximization, accumulation. I'm trying to get you to the accumulation zone as fast as possible. But what happens if I cheat? And by cheating, I mean, instead of doing this mortgage chunk, which I'll get you out of debt even faster than I'm illustrating here, what about if I just stay on course and I start taking money out, but I take that money out so that I can have a longer period of time to grow? Okay. So in this case, I'm talking about taking out $120,000. $10,000 times 12, okay, which is going to push me back. I'm not going to get out of debt in 8 point whatever this year's was. This is 8.6 years. I'm going to get out of debt in about 11 years. So I'm going to push it back, but that's okay, because what I'm doing for that extra 14 months is this. I'm creating an annuity stack. My cost for this annuity stack is $120,000. $10,000 times 12. I'm creating $280,000 of additional wealth. And even more importantly, I'm creating $13,944 a year of additional income. So by delaying paying off my mortgage 11, 12, 13, 14 months, I'm creating a scenario where I've got a 245% gain in wealth. One thing I want to make sure everybody understands, where's this money coming from? It's coming from the carrier. I'm not using my money. I'm using the carrier's money to create wealth for me. So earlier I said, when you do that, you stand up, drop the mic and say, sign here, right? Same deal. So this is an annuity stack.
Do you ever is there ever a time where you'd want to pay that money back, or is this just wealth growing and and you don't worry about paying this.
Right.
back.
So I can't, this is a crystal ball question. So each person's different. You know, their goals are
Okay.
different, their end game is different, their age is different, their health is different, how much money they're going to get to realize is different, what their legacy desires are, what their other family members want. There's no one way to answer that question.
Right.
So, but there's always an answer. Does it make sense to pay it back? Maybe. You know, if
Well,
the program is continuing to grow, the program may pay itself off over time anyway, which is probably, that's why I say don't ever encumber more than 90%.
Right. Okay. So my point is, at this point, you have the gap between the two, between the penultimate and the last consumer debt.
Right.
That you're utilizing this process. During that time, there have been previous debts that you're using all of that, those payments from the consumer debt to pay back the loans that you've already taken out. Now you have these loans that are being taken out. So you're still continuing to use those you're still paying those back, right? So you're continuing the payments even beyond the point where you would have stopped or finished paying that consumer debt, correct?
Maybe.
Okay, because, well, I guess it was 12 years that you were saying that he was still paying things back, right? So it was afterwards. Okay.
Maybe, you know, at the end of the day, this scenario A, you get this guy out of debt from 20.6 years down to 8.4. Scenario number B, you execute a mortgage chunking routine, you get him out of debt in 7.3 years. Scenario C, you get him out of debt in 11, maybe 12 years, but you increase his net wealth by 245%. You know, and then what do you want? A, B, or C? Right. So sometimes the longer game makes more sense. Because, you know, at the end of the day, for this gentleman, I don't know that he doesn't have a $2 million pension already built, in which case this additional net wealth growth of $160,000 and $13,000 a year of income doesn't mean anything to him. In which case, okay, then we go with the mortgage chunking routine and we eliminate the debt fast. So like I said, each person's different. All right. So did anybody get anything out of the mortgage chunking versus annuity stacking? Did you get something, Mark? There's a quiz.
I did. I got to run. Thank you, guys.
Thanks, Scott.
I gotta go pick up my drink.
All right. So we got 4 more minutes. Anybody else have any more questions? There's a little bit more in chat. Pure gold. Thanks, Natasha. All right, Mr. Little, are you glad you came?
Absolutely, man. I appreciate you for the invite.
Right on. All right, baby Ruth, you got anything?
I just love this stuff. I want to do it again. No, I'm good.
All right. Well, thank you everybody for coming. I'll get the video posted. It'll be up in the Purdy Slack probably in the next couple of days. If you have any other questions, call Marc Barnes. He can answer your questions.
That's right.
Thanks, everybody. Have a good night.
Thank you,
Thanks,
Scott.
everybody. Thanks, Scott.
Appreciate you. Thank you, Mark.
Thank you.
Bye, guys.